My three dividend stock picks for 2026. We are almost done with 2025, a couple of months left, but I'm really excited to showcase these powerful dividend stocks that not only compound their dividends, but also have some growth in the price appreciation as well. I know I normally talk ETFs, but income is income, and these stocks have been paying me big time. Disclaimer, I do own all three of these. So I hope you enjoy. If you're interested in dividends in the stock market, don't forget to like the video and to subscribe. I've been tracking these stocks for years, and I'm really excited to get into the video. So these three dividend stocks are in my portfolio already and will continue to be so in 2026 unless something insane happens. We're going to cover a number of different sectors and some key points as to why I like these stocks for the long run, the yield being a key component, because you guys know I am an income-focused investor. Now, our first ticker is ENB. It's Enbridge Incorporated, and this is an oil/energy stock. And if you can't tell, it's been booming like mad. It's up 21.33%, and the dividend is the cherry on top, which pays about 5.5% annually. Now, I know a lot of you guys like higher yields, but hear me out. This thing is up 21%, not including the dividend. And when it comes to stocks like these, you don't have to worry about NAV erosion. They're not using options. It's a growing company in a booming industry. Now, one thing with ENB that's interesting on top of all the other fun facts is it's headquartered in Canada, which could be a good thing, could be a bad thing. It depends on how the US and Canada, how the relationship continues to move. So they've been doing pretty solid. We've been happy with each other, and I hope that it continues. Now, also, Enbridge's pipeline system is the longest in North America, and it has the largest oil export pipeline in the world. This thing is massive. If you don't believe me, let's check it out. When it comes to dividend stocks, I know it's a little bit less yield when you're comparing it to something like, I don't know, any of the yield max funds, the round hill funds, but I do like throwing in some growth and income. And typically these, with the power of compounding, can outperform the indices, can outperform the S&P 500, can outperform the NASDAQ. And that's what I love to do. I love to find stocks that I think have the potential to do that. We've seen some instances of Realty Income, which is not featured in this video, but that one has outperformed over its 30-year lifespan and well outperformed. But that's for another video. So what we can see, ENB is lower risk and predictable, which is what I love. I love to see it if you're planning on retiring soon. If you just want to grow and keep reinvesting without having to do any work, ENB. That's why I like it. So it's sustainable, it's growing the dividend, and it's a the long-term goal is shareholder returns. So we can see here on their map, this is all of their resources, basically. So they have a number of different things. They have the pipelines, natural gas, and liquids. They have storage. They have wind farms. They have solar energy operations. They now have gas distribution and storage. They have so many things all over the US and even into the UK as well with those solar farms. Now, the fact that this thing is so large is what really is, I just have a lot of hope in it. It's going to continue on its trend. This thing is outperforming. It's been absolutely amazing. And I did compare it to a couple of other energy stocks, and it is one of the best performers. So what I'll do is I'm going to throw it in a drip calculator and let me show you how the power of compounding makes this a massive winner. 30 years is a very long time to invest, but hear me out. If you have ENB and you hold it for 30 years, the 30 years that the company's been around, since 1995, you would have, from your initial investment of $10,000, $388,000. And this is not just some speculative, oh, it could do this. It has done this. So I love to run those tests and see how much I need to retire, how much I need to replace my income. This thing has already performed well enough that I can just go and look, oh, 30-year history, here's what I would have made throwing 10K into it at the inception. And for me with energy, I'm big on energy. I hold so many energy stocks. All of them pay a dividend because I like to compound, and I think the energy sector is going to continue upward. Things like AI, I mean, it's hard to argue against energy at this point. Your average annual total return is 12.90%. And now hear me out. What I love about this is you're going to get a near 13% total return from buying and holding. You don't have to track what's happening in the market. You don't have to worry about which new ETF is gonna, upset the next one or upset the winner or crazy NAV erosion. And that's why I'm making this video. I wanted to bring back some of these absolute favorite stock picks. And if you're interested in more, definitely let me know in the comments and by liking the video. That will showcase, hey, I'm interested in dividend stocks as well as ETFs, which I definitely want to talk about more. So amazing, a total return of 3,785% in its 30-year history. And this one isn't even the best performer. This is likely the most controversial of my 3 picks for today. We're looking at ticker EPR. EPR Properties, again on the NYSE. This has a 6.2% dividend yield. And what EPR Properties is it's a REIT. And REIT stands for Real Estate Investment Trust. And I love the price of real estate, the fact that it continues to go up. Maybe we are in a bit of a bubble, and maybe that's why this is a worse pick than some of the others, or at least I should say a higher risk choice. And now what ERP does is they own ski resorts, amusement parks, entertainment areas, all sorts of things under that same guise. And again, if we are headed into a recession, this one would probably be the least recession-proof of all of them, but I still think it would hold up. So on the year, it is up 15, almost 16%. When you tie in that 6% dividend, you're looking at a pretty solid return of 20-something plus percent. Now, the downside, we saw this thing tank during the pandemic. It fell from 70, 80 bucks all the way down to 25 and has since then been climbing back. So one thing that is really important with these style of investments is you can try and predict what the market's going to do, what the world is going to do. Are we going to see another crazy world conflict? One thing I will say with a lot of their holdings, they own over 300 different properties. Now, amusement parks, ski resorts, things like that will always cater to those that are more well off. Not me. Not us, depending, maybe you guys, probably not me. So what's a main factor with that is even if we do see a bit of a pullback or recession, there's still a lot of money that rich people will spend at these luxurious resorts. And that's one reason why I'm big on this style of investment. And one thing I love about REITs is it prevents me from having to hold actual real estate, even though I also hold a little bit of real estate, just the house that I live in. It allows me to get some of that capital appreciation. If the market continues to be super hot, I get the dividends on top of that, on top of all the capital appreciation. And where it's different from just owning specific houses like realty income or properties that people live in, it is entertainment properties. And so it's vastly different. There is a really big difference between those two things. And so I think it's cool to have some exposure to larger properties, definitely more rare properties, harder to find properties like ski resorts, like amusement parks, zoos, things of that sort. So if you don't believe me, let's check out the website. Here's why I hold EPR even with a recession being likely. I don't want to say it is likely. I feel like it is likely, but you never know. So there's a diversification in their portfolio itself. Firstly, they're experts at picking these things, understanding how the market's going to do, how we're going to react if our economy, takes a dive. So they're spread out. And spread out not only across the country, but in the types of properties they hold. So we can see they have lodging, like ski lodges, water park lodging, national parks. Then they have skiing resorts. Then they have gaming. They have casino resorts. They have eat and play, which is an interesting category, but it's like Topgolf, bowling, entertainment areas. Amusement parks, water parks. They have museums, zoos, aquariums, live venues for concerts and events. And then they have fitness and wellness, fitness centers, yada, yada, yada. So when you're buying this stock, you're buying a little piece of all of these. And even if we are headed into a recession, I still think a lot of these will maintain. And because the reason I think that is because they're spread out. They're not necessarily a giant vacation you have to take. You're not going to fly across the country and go to Topgolf. You're not going to fly across the country and go to a museum. Maybe you will. But there's certain areas where people will still utilize these as a cheaper option rather than spending a ton of money in travel. Or for the rich people that don't care about recessions, they're still going to go skiing. They're still going to go to amusement parks. They're still going to go to water parks. They're going to do whatever they want because that's kind of what the rich do. If you haven't noticed, it's kind of what they do. So there's so many different styles here where you're kind of targeting the different demographics, the different, lower class, middle class, upper class. And then you also have things like casino resorts, which attracts all of the above. Really, it kind of seems that way. Maybe low, middle, lower class, who knows? Depends on where you are. So I like the diversification, even if we are headed into a worse year in the market. And I will still be buying this even if we see a 20%, a 30% dip, which would be horrific and destroy the portfolios, but then it gives us everything at a lower cost. And this thing did bounce back really nicely after the pandemic plunge, which I cannot say for a lot of other REITs. Even with the crazy drop after the pandemic, it is still up significantly. It's not the better performer when we look at it and how it's compared to ENB, but that dip in the pandemic really, really hurt this stock and the real estate sector as a whole. Because imagine holding, if we did see another pandemic, that would be different. If we saw everything close again, I would not be buying REITs. But hopefully We don't have that happen. Average annual total return for 28 years is 11.52%. So again, not as good, but still really solid. 10K would get you $208,000. That's a ton of money. And if you're thinking that's not enough money, that is a ton of money, and it's already done that. So of the three, this is my least favorite. I will say that. It's a riskier choice, especially if you think we're heading into a recession, but the dividend yield is a little bit higher at that 6.2%, and the results speak for themselves. They really do. Now onto my favorite choice, and I guarantee if you've watched any of my other small channel, you know I talk about this one all the time, ticker MAIN, or Main Street Capital. This is a thing of beauty. It is up 29%. Now listen to me. Are you listening? This is not a growth stock. This is a dividend stock. It's a BDC that stands for Business Development Company. What that means is they basically lend out money. So they're like a bank for these giant businesses, and they target middle market areas where it's a little bit riskier, but a little bit more reward. And they're phenomenal at what they do. And I can tell you that because one, it's up 29% on the year. Now, this yield down here is not true. You can't even see it. Look, dividend yield, 4.76%. It's higher than that substantially. But we're going to get to that, and I'm going to explain why it's higher than that and why Google isn't technically wrong. There's just a lot that goes into this. So Main Street Capital has been a stock that I've held for, I think, the longest in my portfolio currently. I bought it and Realty Income around the same time. Realty Income I did sell because it was just not, it was being outpaced. I mean, how can it keep up? This thing's up 29%, and the yield is roughly 8%. So I've made a amazing profit on it this year, but guess what? I am not selling one bit. I've been dripping. I've been getting that growth and the dividend on top of it, and it has been absolutely amazing. So we're going to look at a couple of things with Main Street Capital. I'm going to show you guys the drip calculator, but first let's look at the dividend. We'll find that real yield, and I'll explain to you why Main Street Capital is so good. To avoid making this video super long, go to Main Street Capital's page if you are interested. They talk about the companies they loan money to, how they choose them, the sectors, all that. It's a really good website, but I have other things I want to talk about. It has paid a dividend for 17 years. 17 years. Look at this. And you see these random spikes and drops, and you're like, oh, that's not good. It's all over the place. It's not. That's one thing that differentiates ETF investing with income to like dividend stocks. Dividend stocks, you want it to consistently go up because the price is supposed to be going up. And so NAV is never really an issue with dividend stocks. It's a kind of an ETF focused issue, but these are great spikes. So what's happening is they are paying special dividends. And Main Street Capital does pay monthly, not even quarterly. So it's kind of like an ETF, except you're getting growth on top of it. And I've just really been blown away. So when we go down here, we can see it's paying 25.5 cents per month, which is very solid. But then you're getting these special dividends where they're just like, hey, we're making so much money and we have to pay out more of it because they want to qualify for those certain tax purposes. So we're going to give you special dividends. And the interesting thing with special dividends is because they're special, they don't factor into the dividend yield. And that's why Google has it at like a 4.8%. But look, we've had 3 special dividends so far this year. I guarantee we'll get another one in December. And we had quite a few last year. We had 4 again. And the year before that, we had 4 again. Some years they've done more, some they seem to always do at least 4. At least they have since around, 2022. Absolutely amazing. One thing though, with Main Street Capital, interest rates are a big factor. And so my whole thought process is because I want interest rates to go down, they likely won't go down. And if they don't go down, Main gets more money. If they get to be too high, then they could lose out on money if they have a lot of like foreclosures, people not paying back the debt that they took out. And by people, I mean companies, right? Because they're not just lending money to whoever. Now, onto the dividend growth portion. It has a very solid 1-year trailing 12-month growth rate of 4.8% and a 3-year CAGR of 5%. Again, when you go farther out, it gets even worse because the growth has really been coming in these last couple of years. Guy, I should edit that out, but I'm so lazy. But we can see their forward yield 6.63%, and it's actually, again, close to that 8% yield when you factor in all these special dividends, which is absolutely amazing. So I'm really excited with Main. It's been one of the best performers in my account. I am up I think I'm up 60 to 70% last time I checked, and I don't even look at this one often. I literally just buy it, I drip it, I buy more every once in a while. I don't care what price it's at, and maybe that will be a flaw eventually, but as long as they're continuing up with this track record, I will be very, very impressed. So now what we're gonna do, we're gonna look at Main's drip calculator, and I guarantee you're not going to anticipate what's coming. So if you ever have someone tell you that dividends always lose to growth, show them Main Street Capital. Show them Realty Income as well. Main has an average annual total return since inception of 18%. 18%. You heard me correctly. Now, one thing that's important with this is in the pandemic era, yes, it took a bit of a drop, but not nearly as bad because, I mean, the lending industry, the overall economy dropped, but it didn't get hurt as bad as like real estate, of course. If you look at Main Street Capital, 10,000 invested at the inception of the stock, too many ETFs on the brain, in 2007, you'd be invested for 18 years. You'd be averaging, again, that 18% per year. You would have a total return of 1,800%, which again, we're going to keep compounding that all the way another decade. Your 10K would be worth $195,000. I know this is a video on my stocks for 2026, but I might have to just do a Main Street Capital video to showcase the power of this stock. It's got growth, it's got dividends, and look at it compared to SPY. The S&P 500, still phenomenal, 10.43% return, average annual return. It can't even keep up. It's not even close. It's not even half of what you get with Main Street Capital. You're looking at an 1,800% gain total return versus 500. And it outpaced the NASDAQ as well. And you can, of course, find growth ETFs that track things similar to this. You can buy ETFs that have all the REITs in them, that have all the BDCs in them. But I really like trying to find a few select stocks that I think can outperform everything in the long run. And I get some dividends and some compounding with that factored in. So absolutely amazing. And I hope you guys have enjoyed this video breakdown. If you want more stock content, more income content, more ETF content, let me know. But specifically, if you liked this video with some dividend stocks, I will do more. So comment and like the video. Thank you guys so much. If you did enjoy this video, you're going to like these popping up on your screen right now. So check them out and let me know what you think. And as always, don't forget to spread some love today.